What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked #1 on Wall Street in the 2024 All-America Institutional Investor Research Survey. April was anything but boring. Today we break down the wild swings in sentiment, policy pivots, and market moves that define the past month. From tariff talk and Trump tweets to Fed signals and market volatility, we'll explore why the market snapped back and what could shift it next. I'm joined by Stephen Gregory, Head of Quantitative Research at Piper Sandler, as we unpack what's driving the market and what investors should watch now.
Hello, Michael. What a wild month April was for markets. One day you'll go on Bloomberg or FactSet, and when you go to a long history, they switch it from a daily to a weekly and then to a monthly. You will not even see in this move.
Absolutely. I was looking at the monthly price chart of the S&P, and I don't know what the heck everyone's talking about. Full disclosure, I typically do look at line charts. Perhaps I should start looking at candle charts. Then you'll see it.
Then you will see it for sure. It's been unbelievable. So one of the things you were talking about this week with clients and the week before was this pendulum of policy shifts and how we're swinging back and forth. Can you talk a little bit about that?
Yeah, I think we've had a pretty good framework on behaviorally understanding what was going to move the market lower or what could cause a reprieve in the market. We did a podcast at the beginning of April and we talked about what would cause the market or when will the market bottom? And it was a bit of a tangent off of the podcast we had done a few weeks earlier, talking about what makes markets go down. And one of the conclusions from that was what makes markets go down is oftentimes the same thing that makes markets go up. And so in the last 4 weeks, we've had mostly incremental positive news, and I say news more so than actions, on the tariff backdrop. And when we stand back and look at the market in February and in March, what was it that single-handedly brought it down? It was the fear around proposed and then eventual announced tariffs. And that fear has been heavily reduced, just looking at the markets today, just from some incremental communication and messaging from President Trump, Treasury Secretary Bessent, and team. And we're back to where we were, actually slightly above where the market started falling sharply from Liberation Day. And not a whole lot's changed. It's been more talk than action. The only thing that's really changed is that they've paused tariffs and left on these unilateral 10% tariffs on just about every country except China. But just if you look back, the intraday market moves and the PM hours, futures, I don't know if we'll do this, but it could be a fun exercise looking at what percentage of the recovery in markets took place in the 60 minutes following statements from Trump and the administration. I would venture to guess that it was the majority of it.
It's been pretty wild. And these moves we've seen have just been huge swings in multiples. It's that sentiment has been such a driver in such a short, condensed period of time than I can ever remember in markets. Underlying, though, and I think this is really interesting, clearly policy is the driver of the P these days. So that's been the swing factor. But underlying, the trends we've seen in terms of earnings bifurcation, and it's been a mixed backdrop economically and in turn with earnings, has still been playing out. So on the way down, to think about it and talk about it in the size and S&P size and style boxes, the group that fell the least, and the group that rose the most was large cap growth. And they've actually been where the stronger earnings are.
Fundamentals are still mattering. It's just been the marginal alpha from a basket perspective. Because like you said, we've seen small cap earnings estimates, companies that are much more sensitive to fear and the economy, estimates have fallen more quickly over the last month.
Yeah. So it's a kind of you have your shorter term cycle being driven by that sentiment swing, which we're now at the more optimistic end of the pendulum, especially when you talk about tariffs in that news. But that's not the only policy agenda items out there. What are some of the other things that could swing that pendulum that you're keeping an eye on?
Yeah, I think that's to complement the improved rhetoric around tariffs. We've also seen more conversations about the coming tax cuts and the timeline of when those are going to get passed. The administration has obviously highlighted some of the new tax cuts, such as no tax on tips, no tax on overtime. Trump even floated no taxes if you make under 150K. Then I think he raised it at one point to 200K. We'll see if that actually happens. There's full expensing of PP&E. So there's a lot of things that are floating, and the market's paying attention to everything coming out of the administration's proverbial mouth or social media tweets.
When you've been talking about and writing about notes, this kind of sentiment pendulum that we're in right now, and to remain balanced, it's been a great call. Every time you say that, I always think of a line you love to repeat, which is happiness equals outcome minus expectation. And that's just been what the market seems to be swinging around at these days.
Yeah. And I think expectations, we were pretty negative. We weren't trying to get ahead of the market, but we were just trying to play it almost as a bit of a sports talk commentator. As the market was going down, and this is all mostly pre-Liberation Day, there were a lot of folks out there talking about the market being oversold and how bearish sentiment was. And a lot of that data was true, but it wasn't the main catalyst. Really, I think it was the weekend of April 6th, so the weekend before Trump paused, we started seeing data. We like to look at news articles. I go on X every once in a while, listen to Spaces. And not only was the investor sentiment data just blown out now for several weeks, you saw people talking about Black Monday and crises and the end of the US economy. The sentiment had just gotten so over extrapolated beyond where certainly the economy was. That's what makes it so hard to buy when the market's down 20%, because it's really hard to see things getting better. But one thing you and I talked about a lot, I remember that weekend talking to you, is that nothing ever stays the same. And so we put out early that week, where that's basically what we reminded investors and said, now's as good as any to take a shot at a bounce in the market. But, we certainly were seeing things that argued that something needed to change. The bond market was certainly becoming a problem. The dollar was sinking. It wasn't that there was going to be a Trump pivot because the S&P was down, but it was going to be a problem for more countries and more markets. And that's where we thought things would basically hit a pivot point. And it did happen that week. And we've recovered pretty much most of the downturn almost year to date since then. And now going from here, I think it's been a lot of talk. The reality is we still have very high tariffs. There's been zero deals at this point. Most recently, President Trump created a tariff on movies, which I know you're upset about. I know you love those foreign films. The reality is that we haven't yet really seen much at all of the economic impact of that. Earnings have been fine, as we expected, because it's all Q1, and guidance really wasn't going to offer much information because companies don't know what's going to happen either. And so most of the macro data, most of the earnings data has been okay, at least the hard macro data. We just got employment last week. That was fine. The unemployment rate didn't budge. We wouldn't expect a big contraction of employment imminently. Probably if that's going to happen, it's going to be this summer or later this year. So right now, the market's given the Trump administration the benefit of the doubt, and probably will continue to until we either see tariff rhetoric turn more negative, or we just get whiplashed by a string of negative hard data.
Where do you see the Fed? That's such an important part, rates, in your hope framework that is kickstarts the housing and all of these things, and small caps and so many parts of the market have been so dependent on that. And that is part of the administration's plan. They do want to see rates lower. What are you going to be looking for? And what are you thinking right now in the rate picture?
Yeah, up until Friday, we had a pretty decent rally, had seen a decent rally in the bond market. Even on the long end, the 10-year got down to about 412, 413. And then we got the payrolls report and we saw a violent sell-off across the curve. So I think the most important data for the Fed and for the bond market, broadly speaking, is employment. When we think about inflation data, you've seen this week the prices paid data for both manufacturing and services shot up to pretty high levels in the high 60s for both of those. Levels we really hadn't seen since the 22 period when the COVID pandemic supply chains really issues showed up. On the flip side, the big difference, though, is oil. Brent oil today is at $57. So you've seen this big bifurcation between rising prices paid indices and sharply falling oil prices, which is not at all what you saw in 2022. So on one hand, you've got deflation from one of the most important commodities on planet Earth. And on the other hand, you have these self-induced price increases from tariffs that could get worse, could get better, really depending. It goes back to how the path of policy for tariffs evolves. So I think the Fed's meeting this Wednesday. I don't think we're going to hear anything new from them. I think the economy, and particularly employment, is still fine in their view. Inflation data, like those prices paid data I mentioned, were higher. Last week, we got PCE and job openings. Those were both fine. So I don't think there's really any incremental data for the Fed to change what they've been saying, which is just we're going to continue to watch the data and we're going to continue to sit on our hands until we see something that warrants a rate cut or a rate hike.
And the clear-cut piece of evidence for them is going to be employment. That's great. One of the things you've been saying has been remain balanced. Don't get too defensive when we were going down. Don't try to chase it on the way up. Now, is that still the roadmap going forward?
I think so. If you perfectly time the bottom of the market and we're defensive on the downturn and we're able to go back into risk on the upturn, and which, remember, after that 10% increase on the day Trump paused, I think the next day we had a 5% sell-off. So you had to really have a strong hand to stay in that whole way up. So we'll see. But yeah, I think you want to be balanced. We're going to get worse macro data, which again, I still think is secondary to tariff rhetoric. So we'll see. Maybe with the markets rebounding, the job backdrop looking okay. I think the Trump administration even commented how it was another good jobs report. So I'm not sure exactly whose economy it is. I guess if it's good data, it's theirs. If it's bad data, it's someone else's. We'll see. But I think it's going to be a period of uncertainty that's going to last for some time. We're going to have high tariffs coming out of this. And even if that is lower than we have today, and if Trump lowers the tariff rate on China to what he campaigned on, which was roughly around 60% he had mentioned a few times, which is roughly half of where it is today. That's still really high tariff levels. And this is going to really take a long time to digest before we can even close to becoming able to fully evaluate the impact on the economy, on earnings. So yeah, I think you want to remain balanced, not getting too offensive, not getting too defensive, and really stick with companies that you can underwrite in difficult times like these.
So remain balanced, keep an eye on employment, keep an eye on earnings.
As always, and at least until we get an overwhelming amount of data, good or bad, as a result of these tariffs, don't fight the Trump talk. It's just like don't fight the Fed. If Trump's going to keep saying positive things, I think the market will keep taking it hook, line, and sinker. Yes, at some point, the market's going to want to see action. And I think we're getting closer to that. And I think we get closer to that in both time because we're moving along that 90-day pause. And as the market goes up, I think we're going to need to see more action. Yeah, as we sit here today around 5650 or so on the S&P 500, we've again moved back to Liberation Day levels, and the multiple's not cheap, which is something that concerns many. Interest rates are still at elevated levels, certainly for mortgages. The Fed's not cutting anytime imminently. So for investors to keep adding to these positions after we've gotten, again, a reduction in uncertainty and tariff news, I think we're going to need some action and need to see some better earnings and some better data. So it probably starts with action from the administration.
Thanks, Michael. Exciting times. Market is never dull.
Great speaking with you as always, Stephen. Next week, we're going to be hosting Craig Fuller, who's the CEO of FreightWaves. A lot of questions about the situation in the ports in the US and China, and whether or not we're going to see empty shelves come back to school time or holiday season later this year. So tune in next week with Craig Fuller.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.